everyone. Welcome to this week's Real Estate Q&A. We are having a lot of fun things going on here at our Sachs Realty office. We've had a major progression with our podcast studio, which is in the build-out out in the back.
The build-out in the back. I thought we weren't telling people our disclosed location for our podcast studio.
Can't say anything.
It's like a bunker.
It is the compound, as I like to refer to it, especially when people come get a tour. Like, welcome to the Sachs Realty compound.
Yeah, we scrubbed. I just finished scrubbing the floor, the concrete floor.
It's killer, though, you guys. It's amazing. And carpet's being installed next week.
Next week.
Yeah.
Our granite countertop for where we sit.
It's
for our Tuesday night podcast.
It's just weeks away, and I'm psyched.
Yeah, it is pretty exciting.
Yeah.
So I think the coolest thing would be when Joe and I get to go to New York City and pick out gear and stuff.
Oh, for sure.
It's our favorite. It's like the superstore for podcasters or anybody that's in video and photography, B&H Photo.
Yeah. Up
in New York City. What do you mean? Yeah, you've never been there.
Haven't been. Heard the stories. That's okay. I'm holding the fort down, per usual, on all trips taken by Todd and Joe.
Melissa's feeling a little bit of FOMO herself.
Yes. And I'm not going to deny that. I am. You know, there's future plans being made daily, but that's okay.
How about our highest and lowest?
This is a new series we have, guys. We're going to be traveling different parts over our nation.
You said we're again.
We are as a company.
You're not going.
No. I like to be included even though I'm not physically there.
Melissa's not going. She's jealous. We're heading to Florida. We're going to Boynton Beach. We're going to Boynton. Then we're going to Boca Raton.
Yep.
Then we'll be podcasting with a friend of ours, John Williams, sitting down in his brand new studio in Boca. But we're going to start a new series called Highest and Lowest. I don't know. Maybe I shouldn't even say it yet because who knows if you guys will like it. We hope that you will.
We'll see. I'm sure they're going to tell us.
Yeah, we're going to travel around and we're going to bring you the highest and lowest priced single family houses. I think that's what it's going to be in an area. So we're going to tour at the time, it's a little tricky, not so tricky now that real estate is sitting on the market longer.
Yeah.
A couple of 6 months ago, maybe a year ago, it would have been a disaster.
Yeah, I know.
Because we'd tell you that the house is available. And by the time we actually finished the recording, it would have been under contract. But now we're looking at properties that have been sitting. We're seeing properties sitting 30, 45 days, all the way up to like 6, 7 months, especially on the higher end. Yeah. We're going to bring you the highest, what your money can buy you in these cities on the lower end, and you know what you can get, and then at the highest possible end that will let us in. I mean, we were trying to get in one that's like $55 million in Boca Raton.
I know.
They shot us down. They said
no.
They said no.
That's okay.
He said, guys, you're like the 800th company that's called to want to video
we get these calls daily. It's a no for you.
Yeah.
Like, okay.
I mean, we don't rank up, or maybe we do. What's it called? $1 million listing?
Oh, yeah.
I mean, if they can't get in.
I know.
We should be able to get it.
We should.
Anyway, all right, let's answer some questions.
Okay.
And for those of you that have patronized our TikTok, we now know it's a, what is it? We still don't know this.
Although I was told it was a TikTok channel.
Somebody posted on the TikTok that it's an account.
Oh, an account.
TikTok account. I don't know.
I'm just going to say it's
TikTok. I have
TikTok.
no idea.
I like Joe's answer.
Anyway, check us out, TikTok. What we're actually trying to do, and you guys, maybe you'll help us. We're trying to get more viewership on our YouTube channel because we've got so much cool stuff that we're doing and about to do. So you could just help us and share it. If you're one of our longtime listeners and you don't mind helping us out, hit that share button. Send us out to your buddies, your family, your friends.
Yeah.
You could even send it to your enemies. We don't mind. I don't mind. It would, at least if they comment exciting stuff that's fun to read.
Share away.
Share away. Thanks. All right, let's answer some questions.
All right. So lots of talk. Again, it keeps on coming through in your comments about the 40-year modification loan for FHA. We did have a comment come in that said, What nobody talks about is how very few FHA offers were accepted between 2020 and 2022. It was such a hot seller's market that the vast majority of the offers accepted was cash or conventional. Anyone who had a FHA loan prior to 2020 would have likely refinanced when rates were under 4% if they could do a conventional loan. I just don't see a lot of people needing or using this. Will there be some? I'm sure there will, but I doubt it will be a significant number of people.
So we're talking about what? Refinancing from a conventional to FHA?
Yes. So what this is saying is he said, will there be some needing to do the modification of the loan? Yes, but he's saying that it's not, FHA really has not been used. It has not been the top loan accepted in these past few years.
Yeah, well, that's because no one was getting inspections, and sellers were selling houses that they hadn't made repairs in some cases for, well, ever.
Yeah.
So, I mean, we all probably live in a house where something's broken. Well, with FHA, they have a different type of inspection or appraisal process where they go over safety issues, safety items that where if windows are broken, they don't open and close right, they don't lock. Concrete issues outside, the sidewalk being raised up or a tripping hazard. A lot of these things, peeling, chipping paint, sellers just weren't willing to fix anything or do anything. So they wouldn't accept those types of loans. And then, of course, cash trumped it all.
Yes.
So, if you had no financing contingency, when people buy houses, there are multiple contingencies that the buyer, has to go through, right? Inspections is a traditional contingency that we watched go away. Financing is another contingency. They have to be approved and be able to get a loan. If not, they can cancel the contract and get their deposit back. So that's a big one, right? And then there are other contingencies, home sale contingencies, where a buyer needs to sell their property before they can actually follow through with the purchase of the new property. But all of the contingencies were basically just wiped out in the last couple of years, or I'd say up until May, June of last year. FHA was out. We are seeing it make a comeback, and we are seeing where FHA is a lot cheaper for many borrowers than a conventional loan, and it's less money down. So we're seeing where the properties are sitting on the market longer. These sellers are willing to accept any type of loan if they can get the price that they're even close to what they want.
Mm-hmm. So let's talk more about that FHA loan modification. We get a lot of comments of our viewers that have difference of opinion. We had a viewer that actually made a comment that she thought it was actually a good idea, that with the pandemic and then added inflation to the mix, and it's going to help a lot of folks get back on their feet and to do some repairs if they need. It's not kicking the can up the road. It's how you look at it, glass half full or empty. And she was saying, you're looking at it half empty.
When we're talking about loan modification and people, not being evicted, right? That's what this comes down to, bailout. Mm-hmm. So, you can look at it in many different ways. And, I've always taken the stance. I mean, no one wants to see people displaced from their house, foreclosed upon. But a lot of people made a lot of bad decisions. And they're still making bad decisions and buying, in my opinion, overpriced housing. A lot of people are buying overpriced housing still. But, look, that's your choice when you can afford it. The issue is, it seems like all of these types of modifications ultimately they affect everyone. They affect the taxpayer in some way, shape, or form. Now as we start to see, good credit people, now their loan origination fees or their fees associated with having great credit that are more expensive than people that have bad credit, and they're just whatever they're trying to do to ensure home ownership. I guess, I don't know, people are struggling. So when you can't make your loan payment, since the pandemic, there have been so many modifications. Over 1 million people have had loan modifications. And, what we know in history is that, if you're still a couple years from the financial issues that you're going through or pandemic related since 2020, 2021, you start to have to look at and say, okay, what needs to change here to help this person, and is just modifying the inevitable or delaying the inevitable going to be good for them, right? So I think when we're looking at these modifications, I guess you just have to trust that the government thinks they know what they're doing, but I wonder about it. So now what they're doing is taking the new Biden plan that he announced in January. It's on the White House website. We can publish the link. What they're doing now is, traditionally, there's been a program out there, a modification, where they could take up to 25% of the defaulting borrower's loan balance, up to 25%. They'll make it a zero interest loan and clump it on the back end of their note. So if they have a 30-year mortgage, after they pay their last payment in 30 years, that 25% will be due. They haven't paid any interest on that. Or if they go and sell that house before they pay it off, they have to pay off that non-interest second mortgage, essentially, right, on the property. They've bumped that up to 30% now, where they could take 30% of your defaulting loan balance. Now they've added to where they can cast that, let's say 70% of your loan balance, into a 40-year mortgage, and then take that 30% second interest-free loan and tack it on the back of 40 years. Now, I mean, that's great. I'm sure that's a huge, if you could take 30% of your debt and wipe it off of your interest, your mortgage payment, forget about it. The question is that really fair for everybody else? I mean, at that point, hey, why don't we just do it for everyone, right? Why don't we just allow everybody to do that? But my question is, who's paying for that? Who ultimately is paying for that? And it's great. I mean, I want to encourage home ownership. I think people, if they want to own a home, they should be able to, but they should also buy what they can afford. And, the other spending, that we see people do that get themselves in trouble and financial trouble, it's not because of one event, a lot of times, that puts them in that position. It's a series of bad business decisions, bad decision making, right? Maybe they overpay for an automobile. Maybe they spend too much money in shopping. They need to reel it in. Maybe they bought too big of a house. Maybe they put too much furniture in it. They had to have the latest and greatest. I don't know what the case is, but I see it. We go in houses all the time and we see people that they're struggling or whatever. And, you look around, you're like, wow, you're driving a pretty new car. I'm not trying to, look, I'm not trying to point fingers or judge people or anything like that. I'm just saying that we are in this habit of bailing people out from the mistakes that they make in their life. And sometimes we just have to fall from our mistake. It's not going to wipe us out. We just need to learn from it, get on with life. But the issue here, Melissa, is that when I have gone in people's houses that are in remodification or, facing foreclosure over sustained periods of time, they haven't done anything in their house. Yeah. They haven't done any repairs. So the question is, a lot of these houses maybe not even fit. Maybe they're not fit. Maybe they're not safe for these people that are getting loan modifications to continue living in the first place. I'll give you a perfect example. I went in a house where, mold was growing off the basement wall. They had a 13-year-old in the house. The family was living there. The basement was, what appeared to be mold, was growing off the walls like 3 and 4 inches. It was so bad I couldn't even breathe, right? There was a hole in the ceiling of the house, and they had a 5-gallon bucket underneath of it, and the hole in the ceiling was in the dining room. They had a 5-gallon bucket. It wasn't catching all the water. The drywall was coming in. The water was going straight down through the floor, and it was in the basement. The basement was soaking wet. And in fact, they had a bedroom in the basement too. So, this is a situation where somebody was losing their property, right? And, so that's what I'm talking about. When they get behind in their mortgage, they start falling behind. They need remodification. There should be something that happens, and maybe they will. I haven't seen it yet, but maybe they will, to where the appraiser goes back out, the same safety appraiser that's looking at, that we just spoke about, the FHA underwriting and FHA appraisal, would be looking at safety items and saying, this house is not habitable. And then what are we going to do? Are we going to fix the house for them too? Are we going to put a new roof on the house? Are we going to put a new heating and air system in? Because if these people can't get caught up on their mortgage payments and they need a 30% reduction of their loan, we all would like to have that, interest free, or they need a 40-year mortgage to pay for their house, what is happening with the components in the house and how are they getting fixed? The other thing where people get into trouble, and if you look at a mortgage, you look at a 30-year mortgage, the amount of money you're buying a payment, right? So you pay $2,700 a month. Let's just use that as an example. Basically, let's just say you're at 5%. 5% a year on that mortgage balance is what gets broken down over 12 months for your 5% rate. Anything, if it's $2,700, anything that you have left over, that $10 or $50 actually goes to buy down your principal, right? So it's next to nothing. When you first buy that house, right, you're taking such a small amount of money and putting it towards your principal or your note, your loan, buying it down, right? Now take that to a 40-year mortgage. My gosh, these people will be buying a $500,000 house. They'll be paying $2 million for it or more by the time they pay it off. It's not an investment at all. The problem is it's going to prevent people, especially ones that have no equity, that have overpaid. It will prevent these people from selling their house. Right. So if they could sell their house, you need about 10% equity in your house, right? You need to have about 10% more than your mortgage payment balance to be able to, in most states, to sell your house and not come to the table with a check to sell your house. Yeah. To pay it off and get $10 in your pocket even, right? It's going to take, these people are going to be stuck in these homes for so long, which I'm not saying is a bad thing.
Well, it appears it's just going to be a short-term fix. Like it's going to get them through that little hump, but the problem will still be there. And now we have continued low inventory as well.
Well, and I'm not saying that we should add to the inventory by evicting people or throwing them out of their mortgages, but but at the same point in time, there is a little bit of that does add to the inventory every year. And unfortunately, that's how a lot of these houses get renovated. Yeah. So what happens, the reason why flippers are even in business or exist is because of people that don't take care of their houses. So they become distressed sales. Mm-hmm. So when you take a person that hasn't been able to afford their payment, and then you take the fact that they haven't fixed anything, now you really have a house that's worth a lot less than market value. Yeah. They're buried in the house, right? And so as far as being able to come out of it, above board with money. So what happens, I guess my point, unfortunately, is the inevitable ends up catching up. Right? We bail the people out. We extend the mortgage, term. They don't fix anything still, right? And then what happens is they end up in another 5 years being foreclosed on anyway, or just moving out of the house, which we've seen a lot of, especially during the 2008 crisis. They just bailed out of the house completely. They're like, I can't live in the house. It's not safe. It doesn't have a heat system. And that's another thing. I mean, I've gone in places where, people have caused fires, they pass away because they carbon monoxide, because they turn their gas range on to heat the house in the wintertime. I mean, it's a mess. I think what we really need to do is, instead of just coming up with these policies that get them votes, I think we need to, and I'm not a politician, but I think we actually need to think about things that will work.
So let's talk about people that want to be landlords. And we had a question come in from a viewer. Why would any landlord invest in property with rent control? There is no money in affordable housing. And
I think what they're saying here, and this is from our podcast from our Tuesday night, what Dan had explained, and Dan Hanford, our guest, he has, like I said, 4,000 doors about. What he had suggested was that anything less than $2,000 a month in rent could be subjected to rent control, which is basically where the government caps how much you can increase rents. Now, for a lot of mom and pop landlords, they haven't raised their rent
in
years. Maybe they have a tenant that's been in there for 10 years or whatever. Now they're getting hurt in these, with this type of concept, rent control, because their costs have gone up. And now all of a sudden they have an apartment where maybe they were charging $1,100 a month and real market rents are $1,400 or $1,500 a month. And they won't be able with rent controls to just get it to that number as their costs are coming up. So a lot of these landlords that haven't raised their rent will get in trouble with this. And it's ultimately going to hurt tenants too, because the landlords that didn't raise rents for years will now say, I'm going to have to raise rents, because if they don't utilize their rent increments that the rent control will allow, they can't eventually catch up when that long-term tenant moves out and someone else moves in, right? Or even as their costs are going up, they won't be able to raise that tenant's rent. So it's ultimately, in a lot of cases, it will hurt tenants, rent control. But the other thing, and ultimately this will hurt tenants too, is, as this question suggests, is that investors are not investing in properties that are less than $2,000 a month rent, because they would be subjected to the government telling them how much they could charge, which again will hurt the tenants, right? So I think that the bottom line, and as we both agreed, Dan and myself agreed in our podcast, is that the government intervention, they come in strong and heavy with a one system type of policy, and it prevents people from wanting to work or invest or build in affordable housing because of the red tape or the regulations. Regulations are good. I'm not saying we shouldn't be regulated, right? It keeps, bad people or bad landlords, it keeps them, in a lot of cases, a lot more above board than what they would be if they didn't have these controls. But people that care, landlords that care, they're doing the right things anyway. I don't need somebody to tell me how to treat human beings. Obviously I'm a business person and I have tenants, and I consider myself a great landlord, not a good landlord, but a great landlord. But the issue here is that, yes, as the government stepping more in to business, they're making it to where people just don't want to fool around with the bureaucracy and the red tape and the hard to make money arena of affordable housing. And that is on both the rental side and the sale side. We talked about that. If you want to, why do these builders build these McMansions, 3,000, 3,600 square foot house that no one can afford, or that very few people can afford when you're looking at the most of the population? It's because they can't make any money building a 1,600 square foot house, because the amount of money that they spent in developing the property, the infrastructure, putting roadways in, curb and gutter, stormwater management, things like that, impact fees, they're so expensive, so costly, and take years and years and years to get through, that when they finally get the approval to build, even on a smallest lot, they're building the biggest box that they can fit on it, where you can high five your neighbor. A lot of that's because of the red tape and how hard it is to develop property.
So Todd, you mentioned stimulus, and we had a viewer ask a question that I'm sure you have an answer to. Where did all the trillions they made available come from?
Well, they fired up the money printing press. They printed more money in 2 years than we have in 200 years, I think. That may not be exactly so, but I think I've heard that somewhere. They just printed money. They put more money into circulation. And it's kind of interesting, because where does that money end up? Where does that money end up? So ultimately, when you take that much money and then you suck it back out from Americans, right? You take it back from the consumer on inflation,
right?
Higher taxes, higher insurance payments. Think about this for a minute. And guys, this is kind of crazy, but think about if you were an insurance company and your buddy, your friend, printed money for you, right? And enabled you to raise your insurance premiums, your rates. You raised them up. And you could just grab that money and put it back into your bank account, right, into your company's account because you wrote insurance. And now that they have more money, you can have more money because you're going to raise your rates. So what they did was they printed all this money, and where did it go? Where did it go? It went back into the pockets of the elitist. Yeah. They're the ones that ended up making up huge because they were like, wow, they're printing money. What did the landlords say? You've got Wall Street institutional landlords raising rates 25, 30%. Where did the money go? Let's print more money and put it into the hands of the wealthy, right? I'm not trying to knock people for being wealthy, but guys, there is no control on that level, right? And you know, I mean, look, you know, a lot of these companies, they're lobbying for their, you know, for regulations and things like that, right? And so, I mean, look, I'm not a politician. I've said it. You know, I'm a business person. It doesn't take a rocket scientist, in my opinion, to figure out what happened to the money. Now the question is, now that inflation is so high, how do you get the money back? How do you get the money back, right? How do you get it back and shred it and get it out of the system? You're not. We're going to talk about raising the debt ceiling, that kind of thing. And, you know, and outrageous spending, outrageous policy spending.
Do you think there's going to be more money printed? Do you think there's going to be more stimulus?
I think there's going to have to be, right? I don't think we're finished with the bank bailouts. $4 trillion they set aside for banks to be able to borrow at par. And here's the thing, guys. When we took our money back in the day, you know, part of the FDIC, part of their job, well, I'll take that back. Part of the Fed's job was to make sure that the banks had enough money in their vaults. You know, a certain percentage of their deposits they had to have in the vault for what was called a bank run. You know, we saw that when SVB went down March 12th weekend. But what happened was, you know, back in the day, I mean, if there were bank runs, this was to protect us from the bank runs of the, you know, many generations ago. And, you know, where people couldn't get their money out. So what happened was the Fed took that reserve away, basically, to where the banks didn't have to take any of that money and put it in a vault. In fact, you would, if you needed if you wanted all your money, you had a lot of money, you couldn't just walk in the bank and take it out. You had to let them know, and they would plan for you to come and get your money. But now what happened was these banks just take your money and they invest it. Well, we saw what happened when people wanted their money, right? The banks just shut down. So the government came in. They said, look, this could be a problem. We need to set aside $4 trillion for banks to borrow at par to be able to cover depositors' bank accounts, you know, if they want their money back. They now said, well, we're going to insure more than $250,000 per depositor, right? So they raised that to make sure that people didn't freak out. And as a result, I mean, what are you going to do? If you need more money to these guys, man, all they do is make more money. Mm-hmm. Yeah. So, of course, they'll keep printing money. I don't know where the end is or where what's going to happen. But sure, I think we're looking at taking 30% of people's mortgages and putting them on the back end. And where's that money come from? I mean, ultimately, where does it come from? Mm-hmm. It comes from taxpayers.
So we had a question. So bottom line, repos coming or not?
Are we talking about auto repos?
Let's do both. Let's do auto. It's probably, you know, meaning residential property repossessions, but let's hit them both.
Yeah, I think that cars have been being repoed. I think people have turned them in. Yeah. You know, I mean, when we were looking at people spending $10,000 or $12,000 over list price for a car, depending on what price it was, but easily $2,000, $3,000, $5,000 more than the MSRP on the auto. That's, you know, there was no inventory. It was interesting. I think that a lot of it was market specific. Here in Maryland, we had, you know, car dealerships with 5 cars on their lot. Then I went down south and saw plenty of cars, but at various time periods. So I think it was market specific. But yes, the biggest thing with the auto industry is they went to a 7-year car loan. I mean, how stupid is that? Right? Yeah. I mean, you know, your car depreciates the minute you take it off the lot. And you can own your car too long to where it starts to cost you tens of thousands of dollars, right? I mean, I just spent $4,000 at the dealership and, you know, on something that was a part that I waited 4 months for. Yeah. And, you know, so I think that, you know, when you have a depreciating something like a car that depreciates the minute you drive it off the lot, there's argument to that now because, you know, you can sell your used car for a lot of money. But my point is a 7-year loan on that? come on, man. These people are like, I don't want this car anymore. It's a piece of junk and now whatever. And they're going to be turning the keys back in.
Let's talk about houses.
Houses, foreclosures. We're bailing people out.
Yeah.
So I don't think we're going to see foreclosures increase much for a while.
What do you say? 2024?
I don't know. I think we have this election that's coming up, right? I think it's a big year. The White House doesn't want, people being evicted of their houses. I think we're going to see more stimulus. I think we're going to see a lot of workout. If people own a house, I think the people that want a house are going to have a hard time getting a house, right? So if you bought a house, I think you're in good shape, even if you can't pay for it, right? But if you want a house that you haven't yet I think credit standards are going to tighten. They have. And, despite whether, somebody with a low credit score may be able to get in with less fees than somebody with a great credit score. Now you're punished, Mr. 800. But I think what's going to happen is it's going to be harder to buy a house. Lack of inventory, lack of affordability. I don't care if the interest rate drops to 5.5%. A lot of people, they have no cash now, even for down payment. So unless the sellers are paying it, which could happen, I think they're going to tighten that up. But if you have a house, they'll continue bailouts.
There you have it, guys. Those are the top questions from this week.
All right. We appreciate you. And if you haven't done so, subscribe to our channel. Smash that alert bell and you'll know every time we upload content just like this. Don't keep it all to yourself. Share it with your friends like we said before. See you next time.
See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.